Hello, all of you. So, welcome back to our channel, and this is closely related to the MBA part of study. Firstly, I'm covering the topics related to the MBA in healthcare and hospital management. So, today, what is my part of topic is health insurance. Okay, let's see how and what health insurance used to cover. What is the definition of health insurance? Health insurance can be defined as any form of insurance whose payment is contingent on the insured incurring additional expenses of losing income because of incapacity or loss of good health. Right? So what happens in that? What happens exactly in the health insurance? It covers all the expenses which will makes to lose your income because of your loss of good health. So it is a part of thing that which will help you to support your good health, and whenever you are not in a good health, you can just take a help with your health insurance. Okay, now what is the types of this? Medical expense insurance, disability income insurance, and long-term care insurance. Okay, now what is the medical expense insurance? The expenses of the insured such as hospital, physician, and other healthcare expenses are covered by this arrangement. So in a medical expense, what we used to cover is hospital, physician, and other healthcare expense, right? Now, what comes in the disability income insurance? What comes in that? Where we lost, like these policies replace lost income when the insured is disabled as a result of sickness or injury. When anyone of you or anyone from your family lost income just because of the disability or a sickness or some injury occurs to them, when this policy can work for you. Payment is made because physical or mental incapacity prevents the insured from working. As the person is not able to work, so this will help you in that way. And now another is the long-term care insurance. Long-term insurance policies promise to pay expenses if the incapacity prohibits the insured activities of daily life. Okay, so these are the three types of health insurance. What is the importance we will be having with this? What is the importance? This will make savings achievable, safe and beneficial instrument, minimizes worry and increases initiative, benefits to the society. Now let's come to the principles of health insurance. What is the principles? It is the market power, what it gives, barriers to entry and exit, uh, how it will be working. Government creates market barriers by putting conditions like compulsory license to sell insurance in jurisdictions and have minimum financial base. These barriers created by the government are justified on the grounds of the customer protection. If the government prohibits the entry of new insurers totally, they provide opportunity for the existing insurers to enjoy substantial market power. Under such circumstances, insurers make excess profits by restoring to high prices of the cost of buyers and societies as a whole. So this is all depends on the government who creates the barriers by putting some conditions compulsory in a way of a license to sell the insurance and to have the minimum of financial base. So what it comes if government will be prohibits the entry of new insurers totally, it will be giving the existing insurers to you enjoy that substantial market power. Now economies of sale also a part of it. The firm's average cost of production decreases with increase in sales production. What happens? Average cost of production, okay, decrease with increase in scales of production. So, this is inversely proportional to each other. An insurer enjoys the market power not only from economies of scale but also from relative market share. A giant insurer in international market may not possess market power. On the contrary, a small firm in the Indian market will have such power. There is a price discrimination. An insurer might offer an identical health insurance policy to agent, direct selling, and the internet quoting different prices for each other. So there will be definitely a price discrimination. Insurance regulators are more concerned about price discrimination when insurer expense or underlying loss of experience do not justify price differences or identical policies. Product differentiation will be there because insurer possesses market power. If he can discriminate his products from those of its competitors in terms of quality, convenience, service, financial soundness, reputation, and other attributes. Externalities is willpower effect. Externality can be positive also and it can be negative. So negative externality that means to be fraudulence claims over there. Like they take the high premium than the others. Positive externality insurers normally seek protection under intellectual property law. There should be a law for their product processing and service innovation. And in that way, many insurance companies indulge in product development activities. Information problems, asymmetric information. Lemon's problem. Lemon's problem, what happens in this? Insurance buyer knows less than the seller about the product. When the insurance buyer who take that insurance don't know exact information, exact things. Okay, so the seller knows a lot of information and the insurance buyer who is taking that knows a little information. Adverse selection when the buyer knows better. When the person who is taking that insurance know better his or her condition than the seller. That means to be uh, impact, which is like a person who is going to buy something and they know that price exact amount and the seller want to sell in a higher prices. So in a way, adverse selection happens. Moral hazard, tendency of people to change their behavior because of insurance. Non-existent information providing false information. That is not at all a good thing. Free rider problem. This problem arises when public goods are available to others at zero or lower cost. If people know that they will get free emergency medical care, it is unlikely that they will purchase private health insurance. This happens when something is coming as in zero or a lower cost, they will be definitely going to take that. Right? Product design, development, and evaluation, that is very necessary. Generation of new ideas. Every time it's necessary to take the new ideas, new growth, new values, new improvements, new quality. Every time is needed. Analyzing the performance. Whenever you really want to design something or develop something or make a quality improvement, then you really need the analyzing process. So you have to analyze the performance of existing products. Previous products analyzing is really needed. Studying the regulatory requirements, what are the regulations over there, and assessing the changes trends in the economy as well as the society. Identify the unsatisfied needs of the customer. So you have to identify everything, cost and price, everything. Analyze. Firstly is analyze, okay, then study, then assess, then identify unsatisfied need which can't be satisfied, and cost and price. Okay, stimulating the creativity of the designer. A designer can come up with a new product on the following lines: the way how to alter the features, how we can change, how we can differentiate the product, the existing product with our new, how to make an effective rearrangement, how we can rearrange that with different products, how to substitute, and how we can provide a substitute for existing product, how we can different the features or different of different products to be combined to develop a superior one. How can a new product be developed in order to match the features with the changing taste and the needs of the consumers? So these are the questions which is really needed. The idea to be finally considered should contain distinctiveness, profitability. Both of the things are needed. Marketability check is needed. Assessment of the external environment, what outside environment needs, what outside environments giving. Everything you have to assess. Demographic environment, you have to see the variation related to the age, climate, genders, race, everything you have to check on. Social environment very necessary nowadays. Economic environment is really needed. Distribution system, how you can distribute. Implementation process, how you can implement legal approval, product promotion, training of the agent, product selling, everything you need. How you can implement. So for the implement, first be legal things needed, then product, how you can promote that product, and what is the training you have to give to your agents and product selling, how you can sell this. The insurer should build up the necessary infrastructure to maintain satisfactory customer service. It should assess the important factors like reliability, ability to offer quality service consistently. Consistently, you have to provide the quality. Responsiveness, promptness in helping the customer, assurance, ability to retain trust and confidence, empathy, caring, and sharing of the for the problem. So these are things needed, and the evaluation of the product is very much needed. You have to evaluate sales volume, you have to evaluate market shares, you have to evaluate customer satisfaction, also the loyalty of your customers. Next is the review. You have to review everything. Concept of reinsurance is the act of transferring risk by the primary insurer to a secondary insurance is a reinsurance. If you are transferring risk to primary and to secondary is known as reinsurance. Primary insurer or direct writing or ceding company, the insurer who had actually issued. Primary is who actually issued the insurance policy at first instance. Reinsurer is the company whom the risk is transferred by the primary insurance, like assuming company. Reinsurance works on the following basic principles. An insurable interest must exist that to be needed. Reinsurance must transfer some portion of the risk from cedent to reinsurer. Some consideration must be passed from cedent to the assuming insurer. Relies on good faith of both the cedent and the reinsurer. Reinsurer is to be liable to the cedent and to the policy holder. Now the types, what are the types? Assumption insurance, which is having a financial difficulties, withdrawing from particular sector, concentrating in a particular geographic area. Indemnity insurance, stabilizing the mortality experience, utilizing the reinsurer's expertise, transferring substandard risk. Indemnity reinsurance having the two types, which is proportional and non-proportional. In proportional transiting indemnity reinsurance, the primary insurer and the reinsurer share the claims. So primary and reinsurer share the claims on the basis of predetermined portion. Non-proportional, no sharing of claims. Okay, so that's all about the health insurance. I hope you like this video. You have to share this with your friends, your family, whoever so is interested and doing MBA. And I hope you like the video. So do subscribe my channel. Stay connected. I'll be definitely uploading more and more lectures. So you will get help with your semester exams. Thanks for watching. Goodbye.